am an experienced accountant who actually transited into a strategic planning and business development role. And in the last 15 years, I worked alongside my CEO and board to create competitive strategies and business performance to enhance the competitive background and to drive business performance and to enhance shareholders' value. So my accounting background was a great asset to me because with the numbers at my fingertips, negotiations were made easier, and then strategic thinking became my favorite portfolio. So when I need to make business decision, it was easier because I had the financial acumen and I had the number with me. So I was able to strategize, plan, and decide confidently, getting the best and the optimal return of investment. Therefore, I cannot stress more on the importance and relation between strategic thinking and financial acumen. Both are interrelated and mutually inclusive and critical for management to make informed decisions. When executives understand business strategy and finance, they are able to develop strategic agility in the face of disruption, and they can make decisions faster and smarter decisions. So strategic agenda is always evolving, so you need to create winning strategy with financial acumen so that your organization can get a distinct advantage. That will open up opportunities to make profitable differentiation. And with that, you can formulate an execution plan, drive organization alignment, and improve financial performance. This way, your company can stay ahead of emerging organizations and drive innovation initiatives to succeed in today's more challenging market. Don't you think that this pandemic has proven what I have just said? Because business owners who put on their strategic thinking cap during this pandemic, they are able to switch to online, and they are now reaping the benefits compared to those who stick to traditional business. So they were courageous to change because they can see their bottom lines sinking deeper if they don't change. That is why financial acumen is important for your health and for your business. Okay, so how many of you actually are able to be involved in your company's business plan? And how many of you are actually familiar with the integration between business and financial cycle? I think not many, right? Because in many companies, the strategies remain in the head of the CEO. Without being involved in the strategy process, most managers feel no commitment to or ownership of the vision of the company. So rightfully, a business plan should take place yearly between CEO and the senior management. Once this vision is reconfirmed or changed, you move on to prepare the company's budget, followed by setting of the KPI, and then you end the year with auditors auditing your financial statement. This is actually the usual process that you should go to in every company and not leave the decision all to the CEO. So what do you do at the business plan stage? Put on your strategic thinking cap, discuss your vision, where you want the direction of your company to be. Then follow up with your strategic planning or your operational planning. If the current direction is to venture into new areas, then you should actually look at your strategic planning, meaning that you are looking at new products, new markets, and new acquisition. But if you decide that your focus is on operational planning, then you need to reassess your current return on investment. All this planning requires financial knowledge. Budgeting is a must. Budgeting is allocation of funds and resources. Whether you focus on internal improvement or you want to venture into new markets or new projects, you need to budget adequately for cash and manpower to carry out your plans and new plans. Also note that budgeting must be almost precise, because normally companies use the budget numbers to prepare the estimated tax, monthly tax that you have to pay to income tax. So if your estimates vary too much from the actual, heavy penalties are imposed by income tax department, especially if there is an underestimation of profit. Next, CEO and managers definitely want to assess the outcome of current and new plans, especially those you have agreed to have bigger budgets. They will set quantitative KPIs. Example, if you decide to launch a new product, you need to measure if the new product is giving you the required profit margin. Say you set the KPI at operating margin of 10%. At financial performance stage, results show only 5% achievement. At this stage, everyone needs to analyze what went wrong. Is it the product itself, or the marketing strategy, or the market as a whole is not doing well? So from this business and financial cycle, you can see that finance is everywhere. So that is why when I started this session, I said that even if you're not in finance role, you must be concerned with finance. So in a nutshell, these are how financial literacy can help you. Knowing the impact your actions have on the broader organization's financial health can keep you in the big picture in your mind. And when you're faced with financial or difficult business decision, it is easier for you to build a strong case to defend your budget. For instance, if your team is requesting funding for project management software, you have a stronger case of getting your budget approved if you could calculate the anticipated return on investing this software. Providing the impact on your company's bottom line will help you make your case more compelling. Whether you're negotiating a salary or benefits or the scope of a project, having an understanding of the bigger financial picture can actually help to sway the outcome to your favor. If you understand how each expense impact the liabilities in the company's profit and loss and budget, it will be easier for you to identify ways to be more cost-effective and financial efficient. So who is this guy? In the IT world, people talk about Bill Gates and Steve Jobs. In the financial world, Warren Buffett is this guy, the Bill Gates of the financial world. He is one of the most successful investors in the world and has a net worth of over 96 billion as of last month, making him the world's sixth wealthiest person. He's actually dropped from 4th to 6th now. Okay, why do I show this guy? Because he said that accounting is the language of business. As with any other foreign language, to speak a foreign language is always difficult. So finance being a language on its own, it will take time for you to learn, but once you know it, it pays off big later. So what he said is accounting is a language of its own. Financial records and accounting reports tell the story of how a company is doing financially. In other words, financials are the tools to take the temperature of a company's health. If you know the accounting language, you can communicate with any other investors or financial people internationally, and they will understand you if you talk about financial statement or financial rules. So just say profit and loss, and every business person in the world will understand what it means. Okay, so finance is a language on its own. So to help you understand the accounting language for those who have no basic, for those who have basic, do bear with me and take it as a refresher. So we will start with understanding the accounting process and how this process generates the financial report. We will use an example here. Sales department make a credit sales. Okay, so in the accounting process, if there is a credit sales, you always start the accounting process with source document. Okay, in our example of credit sales, the source document will be the sales invoice. So when accounts receive this sales invoice or the source document, accounts will analyze the transaction, what to debit and what to credit. So in this case, the relevant accounts will be trade receivable, since it's credit and not cash transaction, and your sales will be your revenue. So accounts department will then prepare a journal entry for every transaction. In our example, the journal entry will record trade receivable and revenue. And at month end, your exec will post all the accounts into the respective ledgers. Again, in our example, it will be the trade receivable and the sales ledger. And from the ledgers, the trial balance will be prepared. And from trial balance, you generate financial statement. Okay, so at year end, this financial statement will be audited by the auditors. So in summary, accounting process is actually the act of recording, classifying, and summarizing every economic transaction so that you can prepare the financial statements. And for non-financial people, do leave the debit and credit to accounts department. What you need to understand is how your action is captured in the financial statement and how to use this financial statement to help you in your work. So I think for those who are familiar in your company, most of the time you will get people from finance who will always chase you. Please give me the invoice. Please give me the your advance claim so that I can close the account. So do understand that it is important for you to actually submit whatever transaction that you have committed or you have transacted to finance, so that your financial statement is not understated at the month end. Okay, so what are financial statements? Financial statement consists of profit or loss account, equity statement, balance sheet, and cash flow. Okay, remember earlier I mentioned that accounting is the language of business. These financial statements are part of the accounting language. And mind you, recently or a couple of years back, about 10 years or so, accountants have decided to glamorize the accounting language. So instead of a simple profit and loss that we know, it is now called statement of comprehensive income. In US, they always call it income statement, but for Malaysia, we have actually officially put it as statement of comprehensive income or statement of profit and loss and comprehensive income. Now, second one is the statement of changes in equity. This was introduced not so long ago, but during my time, we did not have this separate statement for equity. It was part of the balance sheet. Now, balance sheet also has a new name, statement of financial position. And then they ran out of glamour names, so cash flow remains statement of cash flow. But if you actually think about it, you can't call a cash flow anything else except cash. Okay, but despite the glamour name, the original names are still widely used by everyone in the business today. So for today, we just stick to the original name. I will go into the details of the financial statement later. Now let us make friends with debit and credit. Okay, why debit and credit? Because one of the most important principles of accounting is the duality principle. The duality principle says that every transaction has two effects. If there is a debit, there must be a credit so that the accounting equation is always balanced. And what is the accounting equation is asset equals equities plus liabilities. Assets are what you own, liabilities are what you owe third parties, and equities are the money that shareholders put into the organization. And this equation actually represents all the components in financial statement, assets, liabilities, and equities. So to balance this equation, we all know that if one side goes up, the other side must also go up and vice versa, so that the equation is balanced. And if you increase only one side, which is the left side or the asset side, then you also reduce the same side. Alternatively, if you increase only the right side, which is the equities and liabilities, you also reduce only the right side to balance the equation. So in summary, debits must equal credit, okay, regardless of which side. Okay, and this is what we call T account, where we apply the debit and credit in duality principle. As explained just now, duality principle is to manage the accounting equation, to balance it so that your balance sheet will be balanced. So for every T transaction, whether it's asset accounts, whether equities account, or whether liabilities account, left is always debit and right is credit. Even in equities account, left is debit and right is credit. And for liabilities, similar. Every account for liabilities, the debit side is the liabilities will have a debit on the left side and the credit on the right side. And when we walked through the accounting process earlier, if you remember, transaction analysis must be completed. And once the transaction analysis is completed by the accounts department, they would already have decided which accounts are relevant, what needs to be recorded in the debit and credit side. So 2 rules for recording. Rule number 1, always start with a debit. And rule number 2, when there's a debit, there's a credit. When you follow these 2 rules, your balance sheet will always balance. Okay, so if you start with debit asset, then you will credit either asset or equities or liabilities, depending on the nature of your transaction. Say you receive 100 ringgit cash from loan. Okay, cash is an asset. So you debit asset, which is debiting cash 100. Rule number 2, remember, you must credit somewhere. And because loan is a liability, you actually credit your liability and you credit with the same amount, which is 100 ringgit. So the principle of debit and credit is once you debit any asset, you must credit either asset or equities or liabilities. And say you start with debit equities, okay? You also have to follow with a credit. You credit either asset or you credit your equities itself or you credit liabilities. And assuming you put an ad in the newspaper, but you haven't paid the advertising company. Advertising expense reduces profit, so you debit profit and loss, and profit and loss actually is in the equities account in balance sheet. So when you debit equities, rule number one, you debit equities, which is your advertising or in your P&L account. Then you have to follow with rule number 2, which is the credit side. And where do you credit? You credit your liabilities because you have not paid the supplier, which is your accounts payable. So by doing this, you actually then balance your account, or you keep to the duality principle of one transaction must always have two effects, debit and credit. So I repeat, rule number 1 for accounting, you always start with debit, and rule number 2, there is a debit, there is always a credit, and the accounting equation will then be balanced. Okay, so this is very basic accounting for those who have no knowledge of accounting. Yeah, and what I am trying to show here is that you can also, if it's too confusing using debit credit, you can use the analogy of increase and decrease for those who try to understand the basic account. So again, to maintain the principle of asset equal liability and equity, so if you increase asset, okay, which actually is a debit, then you increase either equity or liabilities. So when both sides are increased, the equation is balanced. So for those of you who gets confused with debit and credit, try to use the increase and decrease analogy. Okay, so similarly, if you increase your asset and you also reduce your asset, your accounting equation will be balanced because the net impact on asset is nil, but you did not touch equities plus liabilities. So in this case, you will still maintain your accounting equation. I will now illustrate with example of this transaction. Okay, sorry. Again, if you reduce your asset, then you also reduce on the right side, which is your equities and liabilities. Then your accounting equation will be balanced. Okay, next will be, I will just show example using increase and decrease. Okay, okay. Example 1, loan is disbursed by bank to company. When the loan is disbursed by the bank to company will receive cash. At the same time, your borrowings will increase, meaning that liability of company increases. So what is rule number 1? Start with debit first. Cash is asset. So when you debit cash or cash account, you increase your asset. So when you credit liabilities, which is your borrowing accounts, then you increase liabilities. And you see here, assets increases, equity and liabilities increases. So your accounting equation is actually balanced. Okay. Example number 2, purchase equipment by cash. Again, to balance your accounting equation of asset equal equities plus liabilities, when company purchases equipment, you are actually increasing your asset because your equipment increases. But because you use cash to pay for your asset, then it reduces your asset at the same time. Okay, so your equipment increase, you use cash, and your asset reduces at the same time when you actually use the cash to pay. So again, rule number 1, debit your equipment, which you increase your asset. And rule number 2, you must also credit, but here you credit your cash, which is your asset also. So in this way, assets are not impacted effectively, assets remain the same, and you did not touch equities and liabilities. So these are examples of debits and credit for those who have no basic accounting. Yeah. So automatically, I hope that this overview and examples have given those who have no financial knowledge on how debits and credit works. So again, I reiterate, for every transaction, rule number 1 is to start with debit, and rule number 2 to follow up with the credit and ensure that asset equal liability and equities. Yeah. If you have any question, you can type into the chat box. Yeah. Okay, before we will now move on to financial statement, which is the components of financial statement. Okay, we were talking about statement of comprehensive income. So let me just repeat what I mentioned just now. Profit or loss is known now as statement of comprehensive income, but in certain accounts, they call it statement of profit or loss and other comprehensive income. In US, it is called income statement, but here we use statement of comprehensive income. So this statement reflects the transaction over the year. Hence, it is for the year ended. Okay, so for this company is for the year ended 30th June 2017. So your year end can be any month, end of the month in any company, now in any month in the year. So most companies now actually uses 31st December so that they are in sync with tax submission. Okay, profit or loss records the revenue and cost of doing business. So the cost of doing business comprises operating expenses, administrative expenses, and also finance costs. So if your revenue is more than the cost of doing business, of course, you will get a profit before tax. But if it's vice versa, then you will incur loss before taxation. Currently, taxation for companies or Sdn Bhd is now 24%. And sometimes you get income that is not from operation. Example, if you dispose of machinery and then you get a gain, and if that gain is recognized, is under other comprehensive income for the year. Okay, like Forex gain also, or Forex loss will be under other comprehensive income. So at the end of the month or at the end of the year, this statement will show your total comprehensive income for the year, what we used to call net income. Okay, so net income will show you how much income that you actually generated from your operation for that year. Okay, back to revenue. Let me share with you some examples of revenue recognition for different industry. If you're in trading, it's quite simple, straightforward, quantity, and then at the price, and you recognize the transaction. Okay. If you are in service, for example, in accounting firm, you go by number of man hours at the rate per hour. If you are in retail, you actually lease out your retail space based on net lettable area, and how you count is rate per square feet to arrive at the revenue from the rented space. If you are in a hotel, you know that we go by rooms, right? So we call it number of keys in the hotel industry terminology. And you also take into consideration the occupancy rate and the average room rate, or some people call it average daily rate, to give you the revenue. Of course, hotel is not only from room, you also have F&B and other miscellaneous income. And for residential, like selling houses, is not straightforward. You need to know what is your total gross development value, or what you call total SPA values for all the units. Then what you recognize in the statement of comprehensive income for that year is not the total value of the sales, but it depends on your percentage of sales, and also what is your progress on site for the project. So it's not a straightforward recognition of profit and revenue in property development. Okay, so these are examples of revenue recognition for different industry. So next will be equity, where we have statement of equity, changes in equity. In statement of changes in equity, we have share capital and retained profits in this statement. For share capital, it's quite straightforward for a small business, SMEs and PLC. But if you are a public listed companies, then you will have more complicated transaction that needs to be reflected in this statement. Example, if you have preference shares movement, you issue bonus share during the year, you issue bonus rights during the year, or you declare dividend. So that is more complicated for public listed companies who normally have various share issuance. Okay. And at the same time, in your statement of changes in equity, you have also what you call retained profits, where your income for the year, which you actually transferred from profit and loss into retained profits. So this income for the year will be accumulated with your last year's profit to show your total profit or loss accumulated since business started. Okay. Okay, so at the end of the month, you will then transfer it to balance sheet, or you will prepare your balance sheet. And what is our glamour name for balance sheet? It is statement of financial position. Unlike your profit and loss and also your statement of changes in equity, statement of financial position is as at a certain date. So for this company, is as at the year end, which is 30th June 2017. Okay, so remember earlier I spoke a lot about asset equal liability, equities and liabilities. Here in balance sheet, we can see clearly the equation of asset equals equities plus liabilities. So this must equal your equity and liabilities to make the financial statement balance at the end of the year. So what do we have in statement of financial position? Okay, assets are classified as current and non-current assets. Determining period is 12 months. So anything that you own, okay, because asset is what you own and will be in your possession less than 12 months is called current assets. Like inventories, also in current assets, because you are expected to sell it within the next 3 to 4 months. So it goes under current assets. And if you buy property, plant and equipment, or you invest in another company, that will stay with you, is an asset that will stay with you for more than 1 year. It is then classified as non-current asset. Okay, so similar to assets, for your liability side, you will also be categorizing it under non-current and current liabilities. Same with asset, the determining period is also 1 year. And how do you classify, say, your loan? You take loan for, say, 3 years. So those portion that you will have to repay within 1 year, you will classify under current liabilities because you have to pay within the next 1 year. And those that you have to pay after 1 year up to the tenure of the loan, you classify under non-current liabilities. So basically the 1 year period is the one that will split or determine which category the asset will go or the liabilities will go under. And you also have, as I mentioned earlier, the share capital and reserves, which will then be reflected from your statement of changes in equity, which will be transferred to this statement of financial position at year end. Some companies, instead of using retained earning, they actually use the word reserves too. Okay, they are the same, it's just a different terminology. Okay, next will be cash flow. Statement of cash flow reports on a company's actual cash payment made or received. They are classified as either operating activities or investing activities or financing activities. So how do you split them? Cash flow from your operating activities means your daily transaction, then you classify as cash flow from operating activities. But if you have your cash activities from investing or cash generated from or by long term, example, purchase of property, plant and equipment, then you classify them under investing activities. And cash that you use to fund the company, whether it's equity or loan, then you classify under financing. Okay, so if you issue additional shares during the year or your shareholders pump in more money, then your cash inflow for that year will be classified under financing activities. Okay, so we have seen 4 financial statements: statement of comprehensive income, statement of changes in equity, statement of financial position, and statement of cash flow. But remember that if you look at your annual report or your audited accounts, you also have the notes to financial statement. You must read the notes together with all these 4 financial statements, because the note actually outline the assumptions that you use in preparation of your accounts, the accounting policies that you adopted, and it also gives you the details to each component of your financial statement. So now let's see what is the relationship between one financial statement and another financial statement. Okay, let's start with the statement of comprehensive income or profit and loss. So during the year, assuming you make income for the year, means you have net income. This net income will then be shown in your statement of changes in equity as your comprehensive income for the year. In this case, the company is making a loss for the year, and this one will go under your retained profits. So at year end or month end, your total share capital and your retained profits will be transferred to statement of financial position. Okay, so in your statement of financial position, you will split the share capital as one item and your retained earnings or reserves as another item. Okay, then back to your profit and loss account, you have profit before taxation. You use the profit before taxation to prepare your statement of cash flow, where you actually adjust your non-cash transaction, like depreciation, and if you have any amortization, so that you can arrive at your net cash generated from operating activities. These are your normal trading every month or every year. Yeah. Then you add the cash that you get from investing activities, whether positive or negative, and your financing activities to arrive at your cash at year end. And this cash at year end will be the same as your cash and bank balances in your financial statement. Okay, so this is how financial statements are interlinked with one another, and with the end result of total assets equals to total liabilities. Okay, the next slide is the same on the relationship between this financial statement, but I will show you an actual account, and this is from Top Glove. Top Glove is a public listed company, so you can get their accounts from the website easily. Okay, so Top Glove statement of financial profit or loss. If you can view, click on your speaker view and pull your slides to make it bigger, then you can see clearer. Yeah. Okay, so if you can see here, the profit for the year for Top Glove for year ended 31st August 2020 is actually 1.6 billion. Okay, 1.637 billion. So this profit net of tax for the year, when it goes into, okay, try and reduce it. Okay, so when it goes into statement of changes in equity, it will then be reflected in the retained earnings section. You can see here, retained earnings section of 1.637 billion. So that's how the profit and loss is flowed to statement of changes in equity. Then at month end, again, you will see that the total equity for the year, which is the closing balance at year end for Total Glove, it will be total of share capital of 1.6 billion plus the retained earnings of 1.5 billion, and it will give you 3.187 billion. With this 3.187 billion, it will then be reflected in your statement of financial position, 3.187 billion. Okay, so this is how the financial statements are linked to one another. So similar with what I have shown you just now, to get to your statement of cash flow, you also start with profit before tax of 1.637 billion. And then what happens is that it will go into your statement of cash flow. Here you can see 1.637, and you make an adjustment for all the investing and financing activities to arrive at the final figure of 257 million cash as of 31st August. And this statement of cash flow that shows 257 million will then be shown in your cash and bank balances of your financial statement of 257 million. So this is how financial statements are linked with one another. Okay, so next I will share with you how auditor's report should be looked into. Right. Financial statement that we have just gone through, 4 of them, they are actually prepared by management. So how do you know that they are reliable? So this is where auditor's report comes in useful. And they give you assurance that accounts are done properly because it is actually audited by third party. Earlier we went through debit and credit, so you know that if you do a debit and you do a credit, your balance sheet will always be balanced. But that doesn't mean that the accounts were correctly prepared. Okay, so auditors are third-party independent who actually gives you their opinion on the financial statement, which is why when you read the you read the annual report or you read accounts, you should also look at the auditor's opinion, so because they will give you a third-party independent opinion. So what do the auditors do? They actually review the financial statement to determine if the company has prepared its accounts in accordance with MFRS, Malaysian Financial Reporting Standard, IFRS, International Financial Reporting Standard, and Companies Act 2016. Okay, there are 4 types of audit opinion that I will share with you. The first is unqualified opinion. So when do auditors give unqualified opinions? When they think that they are of the opinion that your accounts or your financial statement have been presented fairly. And financial statements are presented fairly when sufficient audit evidence has been given to the auditors, and based on this evidence, the auditor says that you have complied with MFRS, IFRS, and Companies Act. Okay, second, next will be qualified opinion. And qualified opinion is issued when they are of or the opinion that your financial statement has been presented fairly, meaning that generally everything is okay, except for there is certain transaction or one transaction which they think that you have not complied with. Then they will issue you a qualified opinion. And this is on the basis that you have given them sufficient audit evidence. They also think that you have complied with MFRS, IFRS, and Companies Act, except for this one transaction where they think that you have not complied with the accounting standards, or they could not get enough audit evidence for that one particular transaction. But generally, it's okay. And normally, qualified opinions is issued on the basis that the company can easily rectify the issues. Okay. And third is adverse opinion. This is issued when they are of the opinion, auditors say that no, your accounts have not been prepared and is not presented fairly. And no companies want this type of opinion. And why would auditors give such adverse opinion? Because you have given them enough audit evidence, and based on the evidence that they have accumulated, they think that you have not complied with MFRS, IFRS, and Companies Act. So meaning that there is a difference in opinion between how you should treat the transaction between management and the auditors. Okay, the fourth one that I'm sharing is disclaimer of opinion. Okay, this is definitely a no-no. No company would want this, because what the auditors are saying is basically they don't have an opinion on your financial statement. And this happens when auditors are unable to obtain audit evidences, and without this evidence, they can't make an opinion. They have no opinion whether your financial statement were prepared according to MFRS, IFRS, and Companies Act. Okay, so I will share with you one unqualified audit report, and this is issued by PricewaterhouseCoopers or PwC for a public listed company. And what the auditor is saying here is basically the accounts is prepared or was prepared on a true and fair view representation of the financial position of the company. And why do they say that is true and fair view? True and fair view is the standard wording that the auditors use, because auditors will not say that the accounts are correct, because they only do random testing. Yeah. So when do they say, and why do they say it's true and fair? Because they have received the company's account, they have reviewed the company account, and the records show that the financial statement were prepared in accordance with Malaysian financial reporting standards, international financing reporting standards, and the requirements of Companies Act 2016. Okay, and why do they actually make this opinion? It is to tell the readers of the audit report that their audit opinion is on the basis that they have obtained sufficient and appropriate evidence to say that your financial statement has been prepared and presented fairly. Okay, so but do take into consideration that auditor's report is not an analysis of the company's earning performance. Yeah, it's not to tell you how well the company is doing. It's also not an evaluation of whether this company is a good investment, but it does give you the comfort that this company's financial statement can be relied on if you're looking to invest in this company, if the auditor actually issued an unqualified opinion. Okay, so investors do look into auditor's opinion because the report measures the reliability of the financial statement in which the investor may rely upon. All right, we did see the financial statements of Top Glove just now, how we actually link from one financial statement to the other. So that was at 31st August. So for those who do not have the basic, I hope you can now say that, yeah, I can read the financial statement now. Okay, then let me share with you is group account. What we saw just now was just the company account. And for the group account, it actually shows you net income of 1.8 billion. They have total assets of 8.7 billion and total liabilities of 2.5 billion. Now with these numbers, right, how do you take the temperature of this glove manufacturing company? And from these numbers, can you actually say that Top Glove is a healthy company? Okay, this is where there is a limitation of the financial statement by just looking at the absolute number. Okay, so if we say that the net income of 1.8 billion, it seems like a lot, but is it a large amount for a company of Top Glove size? After all, Top Glove is the world's largest manufacturer of gloves. So again, we talk about total assets of 8.7 billion. So given the volume of business that Top Glove does as world's largest manufacturer of gloves, is this amount too much, too little, or just right? For total liabilities of 2.5 billion, we ask ourselves, is this level of debt too high for Top Glove, or is it too low and they are actually leveraging too much on equity? So having just this financial statement is not enough to answer the questions that we want financial statement users to know. So without further analysis, these raw numbers actually don't tell much of a story, though they do tell you how much they have in terms of, for example, asset. So what do you do is you use financial ratio analysis to measure the temperature of your company. And what does the financial ratio analysis do? It enables you to quantitatively assess the financial health of a company, whether it is your own company or when you want to assess a target company that you may wish to invest in. So does the company or your company have enough cash to pay bills? If no, your temperature will be very high. Or you ask the question, is your company using its asset effectively to increase profit? If yes, yeah, you can lower your temperature. And is your company a good candidate for investment? Or maybe if it's very good, your mercury color will turn blue. Okay, financial analysis ratio helps you with the trending and also enables you to compare your business with others in the same industry. So is your thermometer showing good temperature of your company? In other words, is your company already a great company or on its way to being a great company? You can use this 6 types of thermometer to measure the temperature, current ratio, debt equity ratio, receivables turnover ratios, inventory turnover ratios, profit before tax margin, and return on equities. These are quite common ratios that are used by companies when they want to, when they present to their financial statement at the end of the month to their board or to their CEOs and management. And also in certain companies, when you do tender evaluation, you want to assess the company that submits tender to you to see whether the company is actually in good financial state before you actually appoint them. Then they also use financial ratio analysis, and they actually look at sometimes 2 years of accounts and they put weightage to each year. For example, last year of higher weightage and the year before on a lower weightage. So what does this ratio tells you? First, current ratio. Okay, current ratio tells you the ability of your company to pay short-term liabilities that are due within a year. A low current ratio may indicate that the company is unable to meet its short-term debts in the event of emergency. If there's no emergency, it's okay. So the rule of thumb that normally the industry uses is the current ratio should be at least 1.5 to 1, meaning that current asset 1.5 times more than your current liabilities, so to consider that the company is actually safe to invest. And if you have 2 to 1 ratio, then it's considered as a perfect mix between current asset and current liabilities. So in last year in June 2019, real estate is about 1.48, retail is about 1.47, but I think with the pandemic now, quite a bit of difference now because a lot of companies are cash strapped, yeah. So next slide is the debt equity ratio. Debt equity ratio is also known as gearing ratio. So it tells you how much borrowings that you have taken compared to the cash invested by shareholders. So for example, if your debt to equity is 0.4, it means that for every ringgit that the investor has invested in your company, 40 cents is actually from loan, from borrowings. So the higher the ratio, it means that the higher your borrowings, so the higher the risk taken by the company. So temperature will surely go up if this ratio is too high. Yeah? And companies that carries high gearing ratio are normally regulated entities like utilities, or you are a monopoly in the industry. Because if you are a monopoly, then it's okay because your financial risk is mitigated by the strong industry position. And like manufacturing, where you have capital intensive, you're capital intensive, then you will likely be higher in terms of borrowing compared to equity because it takes a lot to ask the investor to actually put in the money. So it depends on the industry that you are in. Yeah. And the third ratio that is commonly used is actually receivables turnover days, or you also call it average collection period. And this ratio shows how well the company collects its receivables. And this actually reflects your company's policy in terms of credit policies. Because if, say, your credit policy to customer is 30 days, but your ratio after computing your accounts receivable over your sales, it shows that it is 60 days, then it means that you're not efficient in collecting that. You give your customer 30 days credit period, but your accounts at the end of the year shows that you're only collecting after 60 days. So in such situation, customers are actually paying you after the credit period of 30 days. So what you should do then is chase your sales or chase your accounts people to chase your customers to pay on time so that your cash flow is better managed. The next ratio that is normally used is inventory turnover days. very common for manufacturing, because this ratio actually measures how well your inventory is managed. So in layman's term, it actually says that if your inventory turnover days is low, it shows how fast you sell your product. So if your product meets market demand, sales is high, and you will keep your inventory lower, because the more inventory you have, the more risk you have from the fluctuation in market price, and also you may actually face obsolescence issues. Okay, so a low ratio, a low number of days is always favorable, because it implies product marketability, indicates that you have the need for storage is reduced, and also your holding cost is reduced. A good example is actually McDonald's, because their inventory turnover days is really, really, really low. It's as low as like 7 days for me. Yeah, because it's fast food. Okay, so what measures how much before tax profit for every ringgit you generate in sales? It's called profit before tax margin, and it is in percentage terms. Okay, so what it means here is, if your profit before tax margin is 10%, for every ringgit of sales or revenue that the company make, you're actually making 10 cents in profit before tax. Okay, before tax. So, but this doesn't mean that if you increase your revenue, your profit before tax margin is going to increase, because if you increase your revenue, you need to be able to control your expenses to ensure that your profit is not eroded by the higher expenses. Okay, next will be return on equity. ROE, or what we call return on equity, it measures how much after-tax profit for every ringgit invested by shareholders. Now, ROE is also measured in percentage terms, because if you use ROE, investors can see if they are getting good return on their money, and the company can also evaluate how efficiently you are utilizing the firm's equity. The recent result by S&P in the 500 index says that as of January 2020, market average for ROE is slightly above 13%. So if your company is doing above 13%, yeah, they're okay. Yeah. So a high ROE could mean that the company is generating profit internally well, successfully. However, this ratio, return on equity, it doesn't fully show the risk associated with that return, because a company can rely heavily on debt to generate a higher net profit. Because if you use less equity and higher debt, then your return on equity will be higher. So for some companies, they actually use ROA, or return on asset, because return on asset will have the base as equity and debt, and it's more balanced. Okay, so from the 6 common ratios that I've shared with you, you can see that almost all the numbers are from balance sheet. So it tells you that statement of financial position is very important to enable you to measure the health of your company. So let's look at how the financial ratio analysis that we've seen, the ratios that we've seen, how do you use it within and across industry? Okay, so again, I'll use Top Glove's financial figures. Okay, we see here that the margin, profit before tax margin of Top Glove is 30% for 31st August 2020. So profit before tax margin of 30%, does this tell you whether it's good or not good? It basically tells you not much, but if you can compare to last year's result, then you can see that there is a stark improvement in Top Glove's financial performance. So from 9% last year, it jumped to 30%. The company basically tripled its profit before tax margin. Now, next, we look at the inventory turnover days. Wow, it has reduced its inventory turnover days, even though it's only 5 days, but 5 days make a lot of difference, yeah. So Top Glove has actually managed their inventory slightly better, meaning that they were selling faster and they keep lower inventory than last year. And I think you can actually agree, because you know that in this pandemic, right, the increase for glove has increased, the demand has increased, and definitely better performance by Top Glove since a year ago. And of course, if you look at the receivables turnover days, they have improved fantastically. 41 days compared to 65 days a year ago. So they are collecting their debt much, much faster. So in short, the usefulness of financial ratios is greatly enhanced when you can compare year to year. Here, I only show you 2 years, but normally in financial accounts, they will compare for 5 years. Yeah, so how are other industries in the same, other companies in the same industry doing? So it's helpful not only to look across the timing year to year, but also to look across companies in the same industry. So if we think that Top Glove has performed excellently, let's compare the results to another rubber manufacturing company, Kosan Rubber Industries. Okay, Kosan Rubber Industries year end is 31st December 2020, and it actually generates 40% profit before tax margin. So if you compare Top Glove and Kosan, it will tell you that actually Kosan is doing much better at 40%, and Top Glove is only doing 30%. Okay. However, if you look at the other ratios, it will tell you that the inventory turnover days are actually higher in terms of number of days for Kosan. So meaning that Kosan needs to improve on their inventory management. Similarly, the receivables turnover days is actually longer than Top Glove. So then you'll be asking, how is it then that Kosan Rubber Industries can actually achieve higher profit before tax margin? That's because Kosan Rubber Industry actually has a tighter control on their expenses. So from here, you can see that for you to make a better understanding, you should use more financial ratios to actually find out why is it that Kosan can make higher profit before tax margin compared to the receivable and inventory turnover days. So based on their audited accounts, actually you can see that the cost of goods sold for Kosan is much lower at 40% compared to Top Glove. So which is why it shows that the accounts here shows that Kosan actually made better profit before tax margin. So back to what I mentioned earlier, if you make better revenue, it doesn't mean that you can make better profit, because you need to control your expenses too. So this is really corroborated by Kosan's numbers here to say that they can actually do better by controlling their expenses, even though these two ratios do not show that they are managing their inventory and their receivables better than Top Glove. Okay, so should we compare the financial ratio analysis to other industry? Actually, not really. You should not, because you are actually then comparing like apples to durian. You know, especially during this pandemic, if you compare glove to retail like Parkson, it is non-comparable, because you know that in this pandemic, retail, especially supermarket, hypermarkets, are greatly affected. So you can see from Parkson Holdings Berhad, for their year ended 30th June 2020, they were very badly affected by the lockdown. So their profit before tax margin is negative. So it's not good to compare different industries. So better to compare within industries. Yeah. Okay, so you need to take note that different industries tend to have different financial performance depending on the market situation. So as a comparison, let me just share with you. Computer companies have to contend with rapidly changing prices and specifications. So for computer companies, they tend not to hold on to inventory. So their turnover days can be as low as 8 days compared to, glove industry here and retail industry. Retail industry is about 60 days and restaurants about 14 days. For profit before tax margin, glove here you can see is very good, about 30 to 40, but computer is about 8%, manufacturers about 8%. So actually, if you look at the average, then rubber industry, manufacturing companies are doing fantastic, yeah, which kind of makes sense because of the pandemic. Yeah. Okay, now we move on to appraisal tools used to actually appraise business and investments. We can use various tools, but I will share with you those that are commonly used for financial performance measurement tools to measure financial performance of your company or other companies. And also, if you intend to go into new projects or new business, you can also use these tools to help you to actually assess. Yeah. So the 6 common appraisal tools that is used to assess the financial health of either an existing company or to assess the viability of potential investments are gross operating profit, or we call it GOP, EBITDA, earnings before tax, before interest, tax, depreciation, amortization, and its short form is EBITDA. We also have return on cost, or ROC, which is widely used in property development. We can use yield, and we also can use net present value and internal rate of return, or IRR. These first 4, GOP, EBITDA, ROC, and yield, they are actually earnings-based, meaning that they use the profit to compute your returns. Whereas for net present value, NPV, and IRR, you focus a lot on future cash flows and you use it to discount back to current value. Okay, I will share with you each one very fast. So the first one, gross operating profit. It shows you how well a company is able to generate income, to be profitable, pay debt, and to fund ongoing expenses. And it includes all operating costs except interest and taxation. So interest and taxation, because it is a structure that the company can choose and not from the operating activities, so it excludes this to find out the GOP. Yeah, and it's helpful to investors who are comparing multiple companies with different tax situations. So it shows you the actual return from the operation and is not influenced by tax or your debt structure. Okay, next will be EBITDA, earnings before interest, tax, depreciation, and amortization. So EBITDA is widely used because it excludes expenses not directly related to operations, performance, and profitability. What are the expenses not directly related? It is actually accounting and financial deductions like interest, tax, depreciation, and amortization. Return on cost, as I mentioned, it is quite widely used by developers, and because it measures approximate return from an investment and is useful in evaluating potential return from a stand-alone investment. It's like a one-off profit that you can get. It doesn't take into account time value of money. Okay, and that is actually one of the disadvantage because it doesn't account for the years that you take to actually sell your properties. Okay, yield. Yield is mainly used to measure return on for investment in asset on long-term basis. Example is your property, which you rent out, bonds and mutual funds. Okay, gross yield, you compute it as a return on investment without deducting property tax and expenses. Property tax is quit rent and assessment. Yeah. These are mainly those maintenance in respect of the property. And net yield is after deducting property tax and expenses. Okay, net present value, NPV. This is the most insightful and useful method that uses discounted cash flow. Very meaningful, but quite complicated and quite confusing sometimes to use this. It is more precise because it takes into consideration the risk and time variable. So why is it more precise? Because you know that today's money is worth less by end of next year. Or rather, let's put it the other way, money tomorrow is less than money today. So your 100 ringgit is good now, but not able to buy you what you need in the next 1 year or 2 years. Yeah. So how we use NPV is that if NPV is positive, then it's good to accept the investment that you're considering. But if NPV is negative, decline the project, because after taking into consideration your time value of money, it doesn't give you the profit that is required, even though in absolute numbers it may look good. Okay, the 6 tools that I'm sharing with you will be Project IRR, which measures viability of the project independent of financing structure, meaning that your tax structure is excluded here. So it uses also discounted cash flow. Like I said, it's excluding your financing structure. So when you use the cash flow, you actually exclude interest and debt service payment, meaning that whatever repayment on loan, you don't take into consideration to calculate your internal rate of return. So for Project IRR, if it's more than your cost of capital, meaning either your cost of debt or your weighted average cost of capital, then it's good to go ahead with this project. But if your Project IRR that you compute is less than your cost of capital, then it's good for you to reject or do not consider, or maybe retweak the cash flow that will, or the business model. Okay. Now, methods of evaluation for various industries. I will then share with you different industries that uses different methods to analyze the performance, because most companies will use corroborative methods, which are either based on cash flow or earnings. Both will be used to get a more comfortable evaluation. So we will look at 4 different industries: hotel, retail, office, and residential, and also new businesses. So this evaluation you can use to assess your existing company's performance, or you can actually use it to assess new project. Okay, and different companies in different sectors, again, like what we saw just now, in terms of the return on equity with different companies, they will give you different return, because for NPV and cash flow method, it works well in industry where cash flows are predictable. But if you are capital intensive industry with long gestation period that will only generate profit after a tipping point, then yield is more commonly used. So let me go through each industry and share with you what are the methods of evaluation that they would normally use. Okay, first will be hotel. Okay, normally hotel, the owner and the operator are not the same people. So for example, if you look at Pullman Putrajaya and Pullman Bangsa, they belong to two different owners, but both owners actually appointed Accor Group to run their hotels under the Pullman brand. So how do you use these tools to evaluate the performance? If you are the owner, then you can use the yield tool to evaluate the performance of your hotel, because yield is for, like I said, long-term investment. You want to know whether your hotel is making money over the long-term period. But for the hotel operator, as the owner, you will then use GOP margin or gross operating margin to evaluate whether your operator is actually performing and making money for your hotel. So that is the reason why for hotel you have yield and also GOP margin, depending on from whose perspective are you evaluating. So for hotel industry, how you pay the hotel operator is via the revenue that they generate and also the gross operating profit that they can make for your hotel. So for hotel operator, they are paid basic management fee, which is based on revenue. And then for their performance, if they actually do well and they bring in high gross operating margin, they will get what you call incentive management fees. Okay, so in the industry, hotel industry, during good times, the GOP margin is between 25% to 35%. So if let's say the operator managed to hit GOP margin of 35%, they will get an extra incentive management fee of 7% based on the GOP numbers. Okay, so different purpose and from different perspective of the person evaluating, you use different tools. For retail and office income, they are based on rental from individual retailers or office from businesses occupying the building. So since these buildings are held on long-term basis for rental income, yield is a more suitable tool for the owner. So again, in good times before pandemic, the yield can go up as high as 10%, but generally it's about 6 to 8%. Okay. For property developers, return on cost is the common tool to evaluate the return on investment, because when you launch a project, it's like a one-off and you make profit on that one-off sale to the purchaser. So developers will be able to measure one-off profit against their development costs. So it's actually return on your cost. So again, during property boom era, it can go as high as ROC of 35% to 40%. But like I mentioned also, ROC does not account for the time value of money. So even if you project to get a high ROC of say now 20%, if there's property market overhang, which we know is very high now, inventory can be high, and because you can't sell, then your holding costs will continue to go up as long as you don't sell. And this may wipe out your beautiful ROC. So you need to be careful if you're using ROC, because there's no time value taken into consideration. Okay. For new business, you can use all these appraisal tools, but in addition, normally for new business, you will also use NPV, net present value, or PV, present value, and also project IRR. And however, I think what I would recommend is that you have to use cooperative tools. Yeah. So example, to estimate a value of building, the valuers normally use discounted cash flow method. Okay, and they also use comparison method. So in discounted cash flow method, the future, like I said, this uses cash flow. They will use the future rental of the building and the outgoing expenses to calculate. And then they use a discount rate appropriate for the age, location, and use of the building. then the cash flow will then be discounted back to find out the value of the building. So in practice, no model is used singularly for valuing a company. More often, it is a combination of these metrics to actually give you a better idea of the value of the company or how well your company is actually doing. So you use different evaluation tools. Okay, I share with you a project evaluation that consists of different types of components. Okay, this is like a mixed development project, and you want to evaluate whether you should actually invest in this potential new project. So example is that you have a thermometer in your hand. You sometimes use it on your forehead. You also use it on your palm and your usual is the underarm, and then you get different readings. What would you do if you get different readings? So what you do is that you use all the readings to help you decide. Okay, so for evaluation of potential new project, this is what a potential investor should also do. Okay, so here what I will share with you is a mixed development project where you have components of residential, hotel, retail, office, and what we call public amenities. So you can think of KL Sentral. KL Sentral has got all this residential, you got hotel, you got retail, you got office, and you got public amenities like your LRT, KTM, ERL, you know, converging in KL Sentral. Yeah. So if you're thinking of investing in such project, for example, you should look at each individual component of the project that you want to develop, and then you see the overall before you decide. Okay, so to assess each individual component, again, go back to the tools that I have shared with you and apply the different tools for different components of the project. So here, residential is expected to generate an ROC of 16%. During market boom, this is considered the lower end, but for now, double digit is good. Yeah. And next is hotel. This project is expected to generate GOP of 40%, which is very good. And then NPV, net present value, is positive, which is good. Yield 10% and project IRR 10% is good because the cost of capital used in this evaluation is 7%. So your IRR is higher than your cost of capital, so you should accept this project. Okay, retail is not so good because first, your net present value is negative and the yield is also lower than the average industry. So not a good sign. Office projection, negative NPV, not a good sign too. And your yield and project IRR that you're estimating is also below average industry. And for public amenities, I think we expect this result because public amenities is always a CSR project where you actually don't expect it to make money, but you use other components to cross-subsidize. Yeah. So based on this result that you have, overall is still making good return on ROC, is good on margin. Okay, NPV now overall is positive. Why? Because residential and hotel will be providing the cash flow that's coming in to cross-subsidize the other components. Okay, yield is low because retail and office are low, and project IRR shows a positive figure, a good figure because of the cross-subsidy by residential and hotel. Because you make a combination of all the numbers, that's why it gives you a better result. But if I were ask whether I want to invest in this project, I would say that maybe I will proceed with residential and hotel first, but I will not go ahead with retail and office because taking into consideration the time value of money is not giving you the return that you need. So what I would do is actually relook at these two components and change it or delay this development so that you can actually get very good result from each component so as to cross-subsidize these public amenities. So again, further review would need to be made for all those that are not viable, like retail and office. So this is how an evaluation would be done for mixed development, and using different appraisal tools like return on cost, GOP, NPV, yield, and project IRR to help you to make a decision before you invest. Okay, the last one will be appraisal tools for business or investment valuation. Means that I will whether to value your existing business or to value a target company or investment that you wish to put your funds in. So for this, I will share three different methods that are commonly used. The first one is cost or net asset adjusted. So this is commonly used to set a floor price for any sale transaction, and useful if you're valuing a company that doesn't have a lot of earnings or losing money, but you still have got value in the company because you still have got assets. So it's commonly used by holding companies also that owns part of other companies or real estate. Okay, market value is market-based, and you compare the value of your company with similar business that have been sold. Which for small business would be more difficult because data is restricted, and this is normally used for public listed companies where you can easily, availability of information is easier. Or you can use precedent transaction, where you actually compare to the transactions in the past that has been made with the same characteristic and features. So this is quite commonly used if you are actually acquiring land, for example, where you actually compare the location of the land use and the acreage to another land that is within the vicinity, and then you see whether your value is about the same as what has been sold in the past couple of years. Okay, the more common one that is used is discounted cash flow. Okay, it uses EBITDA and net present value as corroborative tools to assess your value of the business. Remember EBITDA and NPV that I shared with you, and it uses, because it's discounted cash flow, it's actually based on the future free cash flow to project a value for the business. And I share with you a quick one on how they actually use this discounted cash flow. You start with EBITDA. That's why I say you use EBITDA, and you actually take into consideration all this tax, capital expenditure, increase, decrease in working capital, and what is the terminal value for existing, say you want to buy an existing building. So, or existing business, they will have some values. So you account for all this cash flow, because these are all cash transaction, and you arrive at unlevered, which means that without interest, unlevered free cash flow, and this is called enterprise value. So you can use your enterprise value, or they call EV value, to determine the value of your company. And some will go even further to actually use a levered free cash flow or equity value, where you take into consideration your loan repayment and your interest. So this will then give you the value of your company. So this is a quick snapshot of how you use EBITDA, NPV all in one, and a comparison method to actually value an existing business that you want to purchase, or maybe you want to sell your company. You can also use DCF to actually come up with the value of the company. Okay, so business investment valuation is quite complicated. Got to use suitable valuation method, because it actually depends on a lot of assumptions that you use in the method. So you need to get the assumptions correct. Example, one very important assumption is your cost of capital, whether you use weighted average or you use cost of debt. Okay, so it's not necessary to use just one option, as I've shown you earlier. You can use multiple valuation techniques and then you combine the results so that you can get a more reliable and accurate results. So that basically sums up the my sharing for today.